I think, first of all, you're right, because when we are talking about alternative investments, many people are thinking about risk, about complexity, about leverage. So it can be seen as a bit provocative to describe alternative strategies as safe haven investments. But in the current context, where we are facing structural changes, so the debt issue, the demographic issue, the past performance of many risky asset classes, you have to look for other alternatives. And many investors are really looking for products which are flexible, which are controlling risks, so protecting capital or oriented to preserve capital, and of course, which are performing. And I think these three characteristics, so flexibility, downside risk control, and performance, are some characteristics of alternative strategies. And that's why this year, during that seminar, I like to, with my colleagues, to develop on that themes and to show, trying to convince our clients that alternative strategies can be seen as a safe haven investment. Yeah, you're right. The environment has been pretty challenging with risk on, risk off every time, and change of correlation and so on. But first of all, within the alternative segment, you've got various strategies, a large diversity of strategies. And basically, you've got what I call the all-weather strategies, so the ones who are decorrelated, like CTS, for instance, or market-neutral approach, and the other one who are directional strategies, such as long-short equities. So when you are looking at performances over the last 2 years or in 2011, there is not the same performances for all strategies. Some have performed very positively. The performance of CTA over the last 4 years and even over the last 20 years or 25 years is very good, is completely decorrelated, is really adding to portfolio for diversification. And on the other side, performance of long-short equities, just to take an example of directional strategies. Yes, long-short equities have performed badly this year because of these uncertainties and this risk-on, risk-off environment. But what is the objective of these strategies, long-short equities and directional hedge fund strategies, is to perform like equities with half the volatility and much lower drawdown. And if you look at that point, I really think, and I'm convinced that they are fulfilling their objectives. Alternative investment doesn't mean miracle investments. When I'm talking about safe haven investments, it doesn't mean miracle investments. Clearly, if the environment is challenging, if correlation is moving in everywhere, if it's a risk-on, risk-off situation, it's difficult even for hedge fund managers. But because they are really reactive, they are flexible, they are adapting their portfolios, they can perform and deliver returns. And over the last 2, 4, 5 years, yes, maybe performances have been below some expectation, but comparing them to risky assets such as equities in Europe, for instance, alternative investment has really acted as a safe haven investment. Leveraging? Two points. First, about leverage. I disagree that hedge funds are leveraged as many institutional or banks. Banks have far more leverage in average than hedge funds. It's completely on the topic today, and we are discussing about leverage between 15 and 25 for banks, for instance. In average, for the hedge fund industry, it's below 2. Long-short equity, for instance, which are representing a third of the universe, average leverage is 1.5. So much lower than the financial sector. So about leverage, yes, we are using some leverage for some strategies, but the average leverage of the industry is much more lower than the leverage of banks. I agree, but so they have to deleverage their balance sheet. So what you mean is they have to sell assets, and it will be difficult for the hedge fund managers. Here, yes and no, but on one side it creates opportunities because there are less players within the markets. And as banks have to deleverage to trim their activities on proper account, for instance, it means there are less traders. They can endorse less risk. And so there are less competitors for hedge fund managers. And we see that, for instance, in some of our strategies, like a famous strategy we are managing on index arbitrage, so index rebalancing. Here, it's a common strategy for many prop trading desks. And now they are trimming their risk, so there are less competitors and more opportunities for us in that specific strategy, for instance. So the deleveraging of banks or financial institutions, okay, it has impact on prices. so you have to be reactive. But on the other hand, it means less players, and so maybe more inefficiencies and more opportunities for hedge fund managers. So it's, at the end of the day, I think that's more positive rather than negative. And of course, not for hedge funds who are using a lot of leverage, because leverage is more expensive today, but that's a very limited number of strategies. And in average, the industry is not very leveraged. No, I don't think so. They are clearly looking for flexibility, downside risk control, and performances. And what we are really seeing today is long-term investors, such as insurance company, pension funds, are adding to their investments in alternative strategies. And these investors haven't redeemed in 2008, for instance. And so those investors who have redeemed in 2008, like banks or structured products or some private clients, have not anymore, or not for private clients, but for banks and structured products. They are not anymore in the market for investing in hedge funds. So what I mean is today, long-term investors who are really facing liabilities issues, who have to be invested to deliver and to pay on their liabilities, are looking for alternative solutions to invest their money. And alternative strategies are some of these solutions, clearly. And they are adding to their position. Some other players, investors, like banks, were not here anymore. So for me, the client base is far more stable today than 3 years ago. That's the first point. And second point, they are positive. And pension funds haven't redeemed in 2008, and they start to add it again at the beginning of 2009, so very early after the Lehman collapse. So, and they are still adding. So it's validate, in a sense, the positioning of safe haven for alternative strategies. So it's really depending on which clients you are looking at. For me, long-term investors, really, they are adding to their position and they are understanding. They are not buying hedge funds as miracle products. They understand what they are buying, and they are buying hedge funds as diversification products for their global asset allocation. And some others are maybe more short-term oriented, but at less here for the moment within the industry.